and welcome to Markets Today. Well, we have a lot to process following the developments over the weekend, and we'll start with Friday's U.S. non-farm payrolls report, which was abysmal to say the least. The data showed that only 138,000 new jobs were added during the month of May. This was well below expectations of 185,000. And more surprisingly, the previous month, April's report was revised downwards from a reading of 211,000 to 175,000. The unemployment rate showed a drop down to 4.3%. This was the lowest since May 2001. However, this was amidst a falling labor force participation rate, which came in at 62.7%, down from a previous month reading of 62.9%. So don't let that unemployment rate drop trick you too much. Overall, there was also no increase in the average weekly earnings. Those were in line at 0.2%, as expected at 0.2%. So we're not seeing any inflationary pressures, which has been a key decider for the FOMC. Now, following the non-farm payroll report, we did see the US dollar tank to 7-month lows. It fell to about 96.7 levels against a basket of major currencies. Of course, US Treasury yields also decreased following the report, and generally the dollar was oversold following this report. But as I said, the FOMC's meeting that's coming up in 2 weeks doesn't seem to be influencing what's happened following this report, as now markets are pricing in a 95.8% chance that the FOMC will hike rates to that channel between 100 and 125 basis points when they meet in mid-June. We do expect to see some dollar consolidation. As I said, it has fallen to 7-month lows, so watch for it to consolidate above this channel of 96.5 with upward resistance at 97 levels going forward. If we look at the euro, we did have some data coming out of the Eurozone earlier in the European session today. Euro PMI did increase to 53.8. We did have British pound PMI, which did show drawdowns. The British PMI came in at 53.8, while the Euro PMI came in above 55. So this was supportive of the euro. The pound looks to be still very, very susceptible. We have seen it trading between 128.50 and 129.50 levels in the past week, but there doesn't seem to be enough upward momentum in the pound, and this is naturally because of the snap elections that are due up in June 8th. Following the unfortunate attacks in London over the weekend, Theresa May is pushing forward with the elections to be held on June 8th. So we expect to see a little bit of anemic price action in the GBP USD. Look for downside movements towards 128.50 in the lead up to that election, and we of course expect volatility to pick up following that Thursday decision. Having said that, we still like long positions in Euro GBP. Our view from last week, in which we were targeting 0.88 in the Euro GBP cross, looked like it might materialize in trading this week. The Euro GBP did hit a high of 87.66 in trading on Friday. We did see a little bit of that resistance coming in at those levels in trading today. So let's look for 0.88 followed by 0.90 in the month or 2 months ahead. And finally, guys, we do have some more data, including the Commitment of Traders report. Remember, this is a very good report to see how market participants, large speculators and hedge funds are positioned in certain asset classes. And what this did show us was that USD net long positions decreased across the board at the end of last week. We saw upsides in Euro long positions. We saw the number of GBP short positions slightly decrease, and overall the crude positions were largely unchanged. Now, following these developments with regards to Qatar and the GCC, we did see oil prices spike slightly upwards of 48 levels, but they've now consolidated, and we look for further consolidation in crude at 47.55 levels in trading today. Guys, if you found this report useful, please give it a like, please give it a share. If you have any questions regarding what we discussed today, please leave them in the comments below, and I'd be more than happy to address them for you. If you haven't already had a chance, do visit our newsroom at equity.com. It's filled with a lot of interesting content, and it does have a lot of reports and a lot more deeper analysis based on the things we've discussed today.